Penguin Random House Audio presents The Man Who Solved the Market by Gregory Zuckerman. Read for you by Will Dameron. To Gabriel and Elijah, my signals in the noise. Introduction. You do know no one will speak with you, right? I was picking at a salad at a fish restaurant in Cambridge, Massachusetts, in early September 2017, trying my best to get a British mathematician named Nick Patterson to open up about his former company, Renaissance Technologies. I wasn't having much luck. I told Patterson that I wanted to write a book about how James Simons, Renaissance's founder, had created the greatest money-making machine in financial history. Renaissance generated so much wealth that Simons and his colleagues have begun to wield enormous influence in the worlds of politics, science, education, and philanthropy. Anticipating dramatic societal shifts, Simons harnessed algorithms, computer models, and big data before Mark Zuckerberg and his peers had a chance to finish nursery school. Patterson wasn't very encouraging. By then, Simons and his representatives had told me they weren't going to provide much help either. Renaissance executives and others close to Simons, even those I once considered friends, wouldn't return my calls or emails. Even arch-rivals begged out of meetings at Simons's request, as if he was a mafia boss they dared not offend. Over and over, I was reminded of the ironclad 30-page non-disclosure agreements the firm forced employees to sign, preventing even retirees from divulging much. I got it, guys. But come on. I'd been at the Wall Street Journal for a couple of decades. I knew how the game was played. Subjects, even recalcitrant ones, usually come around. After all, who doesn't want a book written about them? Jim Simons and Renaissance Technologies, apparently. I wasn't entirely shocked. Simons and his team are among the most secretive traders Wall Street has encountered, loath to drop even a hint of how they'd conquered financial markets, lest a competitor seize on any clue. Employees avoid media appearances and steer clear of industry conferences and most public gatherings. Simons once quoted Benjamin, the donkey in Animal Farm, to explain his attitude. God gave me a tail to keep off the flies, but I'd rather have had no tail and no flies. That's kind of the way I feel about publicity. I looked up from my meal and forced a smile. This is going to be a battle. I kept at it, probing defenses, looking for openings. Writing about Simons and learning his secrets became my fixation. The obstacles he put up only added allure to the chase. There were compelling reasons I was determined to tell Simons' story. A former math professor, Simons is arguably the most successful trader in the history of modern finance. Since 1988, Renaissance's flagship Medallion hedge fund has generated average annual returns of 66%, racking up trading profits of more than $100 billion. No one in the investment world comes close. Warren Buffett, George Soros, Peter Lynch, Steve Cohen, and Ray Dalio all fall short. In recent years, Renaissance has been scoring over $7 billion annually in trading gains. That's more than the annual revenues of brand-name corporations, including Under Armour, Levi Strauss, Hasbro, and Hyatt Hotels. Here's the absurd thing. While those other companies have tens of thousands of employees, there are just 300 or so at Renaissance. I've determined that Simons is worth about $23 billion. Others at the firm are also billionaires. The average Renaissance employee has nearly $50 million just in the firm's own hedge funds. Simons and his team truly create wealth in the manner of fairy tales full of kings, straw, and lots of gold. More than the trading successes intrigued me. Early on, Simons made a decision to dig through mountains of data, employ advanced mathematics, and develop cutting-edge computer models while others were still relying on intuition, instinct, and old-fashioned research for their own predictions. Simons inspired a revolution that has since swept the investing world. By early 2019, hedge funds and other quantitative, or quant, investors had emerged as the market's largest players, controlling about 30% of stock trading, topping the activity of both individual investors and traditional investing firms. MBAs once scoffed at the thought of relying on a scientific and systematic approach to investing, confident they could hire coders if they were ever needed. Today, coders say the same about MBAs, if they think about them at all. Simons's pioneering methods have been embraced in almost every industry and reach nearly every corner of everyday life. He and his team were crunching statistics, turning tasks over to machines, and relying on algorithms more than 3 decades ago, long before these tactics were embraced in Silicon Valley, the halls of government, sports stadiums, doctors' offices, military command centers, and pretty much everywhere else forecasting is required. Simons developed strategies to corral and manage talent, turning raw brain power and mathematical aptitude into astonishing wealth. He made money from math, and a lot of money at that. A few decades ago, it wasn't remotely possible. Lately, Simons has emerged as a modern-day Medici, subsidizing the salaries of thousands of public school math and science teachers, developing autism treatments, and expanding our understanding of the origins of life. His efforts, while valuable, raise the question of whether one individual should enjoy so much influence. So, too, does the clout of his senior executive, Robert Mercer, who is perhaps the individual most responsible for Donald Trump's presidential victory in 2016. Mercer is no longer Renaissance's co-CEO, but he remains a senior employee of the firm. Mercer, Trump's biggest financial supporter, plucked Steve Bannon and Kellyanne Conway from obscurity and inserted them into the Trump campaign, stabilizing it during a difficult period. Companies formerly owned by Mercer and now in the hands of his daughter, Rebecca, played key roles in the successful campaign to encourage the United Kingdom to leave the European Union. Simons, Mercer, and others at Renaissance will continue to have broad impact for years to come. The successes of Simons and his team prompt a number of challenging questions. What does it say about financial markets that mathematicians and scientists are better at predicting their direction than veteran investors at the largest traditional firms? Do Simons and his colleagues enjoy a fundamental understanding of investing that eludes the rest of us? Do Simons's achievements prove human judgment and intuition are inherently flawed, and that only models and automated systems can handle the deluge of data that seems to overwhelm us? Do the triumph and popularity of Simons's quantitative methods create new, overlooked risks? I was most fascinated by a striking paradox. Simons and his team shouldn't have been the ones to master the market. Simons never took a single finance class, didn't care very much for business, and until he turned 40, only dabbled in trading. A decade later, he still hadn't made much headway. Heck, Simons didn't even do applied mathematics. He did theoretical math, the most impractical kind. His firm, located in a sleepy town on the North Shore of Long Island, hires mathematicians and scientists who don't know anything about investing or the ways of Wall Street. Some are even outright suspicious of capitalism. Yet Simons and his colleagues are the ones who change the way investors approach financial markets, leaving an industry of traders, investors, and other pros in the dust. It's as if a group of tourists, on their first trip to South America, with a few odd-looking tools and meager provisions, discovered El Dorado and proceeded to plunder the Golden City, as hardened explorers looked on in frustration. Finally, I hit my own pay dirt. I learned about Simons's early life, his tenure as a groundbreaking mathematician and Cold War codebreaker, and the volatile early period of his firm. Contacts shared details about Renaissance's most important breakthroughs, as well as recent events featuring more drama and intrigue than I had imagined. Eventually, I conducted more than 400 interviews with more than 30 current and former Renaissance employees. I spoke with an even larger number of Simons's friends, family members, and others who participated in, or were familiar with, the events I describe. I owe deep gratitude to each individual who spent time sharing memories, observations, and insights. Some accepted substantial personal risk to help me tell this story. I hope I rewarded their faith. Even Simons spoke with me, eventually. He asked me not to write this book, and never truly warmed to the project. But Simons was gracious enough to spend more than 10 hours discussing certain periods of his life. while refusing to discuss Renaissance's trading and most other activities, his thoughts were valuable and appreciated. This book is a work of nonfiction. It is based on first-person accounts and recollections of those who witnessed or were aware of the events I depict. I understand that memories fade, so I've done my best to check and confirm every fact, incident, and quote. I've tried to tell Simons's story in a way that will appeal to the general listener, as well as to professionals in quantitative finance and mathematics. I will refer to hidden Markov models, kernel methods of machine learning, and stochastic differential equations, but there will also be broken marriages, corporate intrigue, and panicked traders. For all his insights and prescience, Simons was blindsided by much that took place in his life. That may be the most enduring lesson of his remarkable story.
You were something of a mathematical phenom. You had already taught at Harvard and MIT at a young age. And then the NSA came calling. What was that about?
Well, the NSA didn't exactly, that's the National Security Agency. It didn't exactly come calling. They had an operation in Princeton where they hired mathematicians to attack secret codes and stuff like that. And I knew that existed. And it had a very good policy because you could do half your time at your own mathematics and at least half your time working on their stuff. And they paid a lot. So that was an irresistible pull. So I went...
A way of creating these astonishing returns over 2 decades. I think the way it's been explained to me, what's remarkable about what you did was that it wasn't just the size of the returns, it was that you took them with surprisingly low volatility and risk compared with other hedge funds. So how on earth did you do this, Jim?
Well, I did it by assembling a wonderful group of people. When I started doing trading, I had gotten a little tired of mathematics. I was in my late 30s, I had a little money, I started trading, and it went very well. I made quite a lot of money with pure luck. I mean, I think it was pure luck. It certainly wasn't mathematical modeling. But in looking at the data, after a while, I realized, hey, looks like there's some structure here. And I hired a few mathematicians, and we started trying to make some models. Just the kind of thing we did back at IDA. You design an algorithm, you test it out on a computer, does it work, doesn't it work, and so on.
So can we take a look at this? Because, I mean, here's a typical graph of some commodity or whatever. I mean, I look at that and I say, that's just a random up and down walk, maybe a slight upward trend over that whole period of time. How on earth could you look at that and see something that wasn't just random?
It turns out, in the old days, and this is kind of a graph from the old days, commodities or currencies had a tendency to trend. Not necessarily the very light trend you see here, but trending in periods. And if you decided, okay, I'm going to predict today by the average move in the past 20 days, there's 20 days, maybe that would be a good prediction and I'd make some money. And in fact, years ago, such a system would work. Not beautifully, but it would work. So you'd make money, you'd lose money, you'd make money, but this is a year's worth of days, and you'd make a little money during that period. But it was a very vestigial system.
So you would test a bunch of different sort of lengths of trends and time and see whether, for example, a 10-day trend or a 15-day trend was predictive of what happened next?
Sure. You would try all those things and see what worked best. But the trend following would have been great in the 60s, and it was sort of okay in the 70s. By the 80s, it wasn't such a
It didn't, because everyone could see
that.
Other
people did.
So what happened? So how did you stay ahead of the pack then?
Well, we stayed ahead of the pack by finding other approaches and shorter-term approaches to some extent. But the real thing was to gather a tremendous amount of data, and we had to get it by hand in the early days. We went down to the Federal Reserve and copied interest rate histories and stuff like that because it didn't exist on computers. We got a lot of data and very smart people, and that was the key. I didn't really know how to hire people to do fundamental trading. I had hired a few. Some made money, some didn't make money. I couldn't make a business out of that. But I did know how to hire scientists because I have some taste in that department. And so that's what we did. And gradually these models got better and better and better and better.
I mean, I think you're credited with doing something remarkable at Renaissance, which is building this culture or this group of people who weren't just hired guns who could be lured away by money. Their motivation was doing exciting mathematics and science.
Well, I hope that might be true, but some of it was money.
They made a lot of money.
I can't say that no one came because of the money. I think a lot of them came because of the money, but they also came because it would be fun.
What role did machine learning play in all this?
Well, in a certain sense, what we did was machine learning. You look at a lot of data and you try to simulate different predictive schemes until you get better and better at it. It doesn't necessarily feed back on itself the way we did things, but it worked. And
so these different predictive schemes can be really quite wild, quite unexpected. I mean, you look at everything, right? You look at weather, length of dresses, political opinion.
Length of dresses we didn't try, but
what sort of things?
Well, everything. I mean, everything is grist for the mill except hem lengths. I have to say, weather, annual reports, monthly, quarterly reports, the historic data itself, volumes, you name it, whatever there is. We take in terabytes of data a day and store it away and massage it and get it ready for analysis. And you're looking for anomalies. You're looking for, like you said, the efficient market hypothesis.
But any one anomaly might be just a random thing. So is the secret here to just look at multiple strange anomalies and see when they align?
Well, any one anomaly might be a random thing. However, if you have enough data, you can tell that it's not. So you can see an anomaly that's persisted for a sufficiently long time so that the probability of it being random is not high. But these things fade after a while. Anomalies can get washed out, so you have to keep on top of the business.
A lot of people look at the hedge fund industry now and are sort of shocked by it, by how much wealth is created there and how much talent is going into it. Do you have any worries about that industry and perhaps the financial industry in general, kind of being on a runaway train that's I don't know, helping increase inequality, or how would you champion what's happening?
Well, actually, I think in the last 3 or 4 years, hedge funds have not done especially well. We've done dandy, but the hedge fund industry as a whole has not done so wonderfully. The stock market has been on a roll going up, as everybody knows, and price-earnings ratios have grown. So an awful lot of the wealth that's been created in the last, let's say, 5 or 6 years has not been created by hedge funds. So it's just another, people would ask me, what's a hedge fund? And I say, 1 in 20. I mean, which means now it's 2 in 20. It's 2% fixed fee and 20% of profits. Hedge funds are all different kind of creatures.
Rumor has it you charge slightly higher fees than that.
We charge the highest fees in the world at one time. 5 and 44. That's what we charge.
5 and 44.
Yeah, 5% fixed fee.
5% flat, 44% of upside. But you still made your investors spectacular amounts of money.
We made good returns, yes. People got very mad at my investors. How can you charge such high fees? I said, okay, you can withdraw, but no, how can I get more was what the... but how can I get more? But at a certain point, as I think I told you, we bought out all the investors because there's a capacity. There's a capacity to the fund.
But should we worry about the hedge fund industry attracting too much of the world's great mathematical and other talent to work on that, as opposed to the many other problems in the world?
It's not just mathematical. We hired astronomers and physicists and things like that. I don't think we should worry about it too much. It's still a pretty small industry, and in fact, bringing in science into the investing world has improved that world. It's reduced volatility. It's increased liquidity. Spreads are narrower because people are trading that kind of stuff. So I'm not too worried about Einstein going off. And
who is the greatest investor of all time? Is it Warren Buffett, Ray Dalio, George Soros, or some other investor. This could be considered the pantheon of great investors, if it wasn't missing Renaissance's founder, Jim Simons, who should be considered the world's most successful investor. His legendary Medallion fund has returned 39.1% on average per year since 1988, generating over $104 billion of trading profits. Even better, he is showing no signs of slowing down. Renaissance is often excluded from the best hedge fund list because its well-known Medallion fund's results are hard to verify, as it has been closed to outside investors since 2003. But there is undeniable evidence that the returns are very real. For example, when an employee was fired in 2017, he negotiated into his settlement a clause that allowed him to stay invested in the Medallion fund, which has produced otherworldly returns since 1988. Other facts showing legitimacy is that Renaissance would be the world's worst Ponzi scheme, as it does not allow in outside money. In addition, Securities and Exchange Commission evidence shows it manages over $100 billion of assets, and it confirms its famous 544 structure, which is likely the highest fee structure in the world. This means an investor pays 5% of his assets each year and 44% of his profits to Simons. Even at this structure, investors would line up to invest in Renaissance if it was open to outsiders. Simons' wealth did not come out of thin air, and Renaissance's strong returns has made him one of the richest people in the world. Finally, the IRS is asking for $6.8 billion in back taxes. The IRS believes the strategy used from 2000 to 2015 was for tax avoidance. Renaissance disagrees, but the dispute has not yet been settled. Simons, now 81, is eccentric, despite keeping a low and secretive profile. His secretive personality may have developed when he worked for the Institute for Defense Analysis from 1964 to 1968. Simons remembers not even telling his wife, soon-to-be ex-wife, what he did there. But we now know his task was to decode Soviet messages. Simons' eccentricity shines through during this 2019 interview, where he receives a phone call.
So, when did you first get interested in business? When you were at MIT, you mentioned something about that last week.
I'll have to call you back. What could I say?
He earned more than any hedge fund manager in 2017, with $1.7 billion of fees, and again with $1.6 billion in 2018. Renaissance's strategies are standing the test of time, better than any other legendary active fund, such as Ray Dalio, whose famous Pure Alpha fund has struggled compared to the S&P 500 since the financial crisis. Warren Buffett has made many recent investment mistakes, including his investment in IBM and Kraft Heinz. Buffett's firm has only slightly better results than the S&P 500 since the Great Recession, and this is excluding the incomplete 2019 year, where Berkshire Hathaway is badly losing. So how has Simon continued to have so much success? This video will go through his exciting life. His firm Renaissance Technologies should go down as the greatest fund of all time. In 2001, Simon said the firm downloaded 1 terabyte of information and made 150 to 300,000 trades per day. In 2003, Renaissance increased its fees to its famous 544 structure. It also kicked out all outside investors. Renaissance still has an upper limit on what its core fund Medallion can manage, which seems to be around $10 billion. If it was much larger, then trading could move the markets, limiting its gains. In 2003, with outside investors gone, Renaissance employees could now make more gains for themselves. But in 2005, Simon somewhat relented, and Renaissance launched Renaissance Institutional Equity Fund, or REIF, which as of 2019 manages $27 billion and is still open to outside investors. Renaissance also launched 2 new funds in 2012 and 2016. As we moved through the 2000s, we were seeing the golden age for quantitative investment firms. Goldman Sachs's Quantitative Investment Strategy Unit, or QIS, was in fact larger in 2007 than it is today. A little-known event occurred in August 2007, known as the Quant Quake, demolishing many firms and ending this golden age for the time being. Goldman's epilogue was that too many quant funds had the same strategies, and panic selling created a quake. But it said that this would unlikely happen in 2019, as there are more strategies, but this remains to be seen. Renaissance also lost a lot of money during the 2007 quake, but Simons used his intuition and reduced the firm's trading positions that were doing badly. He also reduced positions during the tech crash when Renaissance was also losing money. He often used intuition in irregular market trading times, as he didn't want to suffer the same fate as long-term capital management, which vanished into history as a rather disgraced fund. Medallion soon recovered, returning a staggering 137% that year. But things weren't all good. Its new fund, REIF, lost money. and in 2009 it lost another 5%, compared to the 27% gain in the S&P 500. Investors then fled Reef, realizing it was not Medallion. Reef was set up to make long-term trades, as to not interfere with the short-term trades of Medallion. Reef's original promise was to beat the S&P 500 by a few percentage points a year. As investors fled, Reef's assets dropped from $30 billion to under $5 billion. Since then, it has mostly recovered. In 2019, it now manages approximately $27 billion of assets and has beat the S&P 500 in most years since 2010. Renaissance's Star Medallion Fund has continued to have unparalleled success. During the financial crisis of 2008, while the market dropped 37%, Medallion returned 152% before fees, its best year ever. It continues to make returns at a breathtaking pace. Simon stepped down as CEO of Renaissance in 2009, leaving the company to be managed by the IBM pair. Renaissance and Simons have a profound legacy and show no signs of slowing down. While legendary investors such as Ray Dalio and Warren Buffett have suffered lower returns in recent years. For example, Warren Buffett has struggled since 2010, making many dreadful investments and barely beating the S&P 500, and will likely be worse once 2019 ends. Ray Dalio's Pure Alpha Fund has returned only 6% a year since 2009, compared to the 12% average of the S&P 500. So while these two are struggling, Renaissance is flourishing. So who is the best investor ever? One argument for Buffett is that he has been able to compound the returns. One flaw with Renaissance is that it can only manage a finite amount of money. Buffett's firm, Berkshire Hathaway, is now worth over $530 billion. Another negative for Renaissance is its returns are pre-tax. Berkshire Hathaway strategies allow for tax deferral. Renaissance has a very poor tax strategy, as its short-term trades have the highest possible capital gains tax at 39.5%. Whether you like Buffett or Simons, these two should go down in history, and Simons deserves to be in the same sentence as Buffett, maybe even ahead of him, because Simon's strategies are better standing the test of time. I hope you enjoyed this video as we explored Renaissance Technologies, the secretive quant fund. If